Imagine just for a second that you can make money simply by predicting if the US dollar is going to get stronger or weaker against another currency. Sounds incredibly simple, right? You just pick a direction, place your trade, and watch the profits roll in. Well, as with literally everything in the financial world, there's a catch. The arena where this kind of speculation goes down is actually one of the largest, fastest, and most intensely active financial markets on the planet. So today, in this explainer, we're going to unpack the actual mechanics and, frankly, the sobering realities behind this massive global machine. We're stripping away all that online hype to look directly at how it actually functions. It's a term you've probably seen plastered all over the internet, usually right next to a picture of a rented Lamborghini or a guy pointing at 6 glowing screens. So, what exactly is Forex? Well, before we can even begin to understand the risks or how fortunes are made and lost here, we have to start at the absolute foundation. We need to define exactly what this marketplace is and, maybe more importantly, what it isn't. Because I promise you, the answer goes way, way beyond that little currency exchange kiosk you stop at before a vacation. All right, let's dive right in. Forex simply stands for foreign exchange. In its most basic, stripped-down terms, it's the global market where one currency is exchanged for another. Now, technically speaking, you might already be a player in this market. Seriously. If you've ever swapped US dollars for euros right before a trip to Paris, you've participated in the foreign exchange market. But professional Forex trading, it takes that everyday concept and pushes it much, much further. You see, instead of swapping currencies because they actually need the physical cash to buy a coffee or a train ticket abroad, traders are trying to profit from the constant minute-by-minute fluctuations in those exchange rates. They're essentially acting as speculators. So, let's talk about currency pairs and rates. Here's a really practical, simple example of how a trade actually works in theory. Let's say you're looking at the market, and the current exchange rate is 1 US dollar equaling 85 Indian rupees. Now, based on your own research, you've got a hunch the dollar is going to get stronger against the rupee in the near future. So you take a position. If the dollar later jumps up to, say, 87 rupees, boom, the exchange rate moved exactly like you predicted. Because your single dollar can now buy more rupees than it could before, you've created a margin of profit there. Forex traders are constantly trying to capture movements exactly like this, little shifts happening all over the world millions of times a day. And this brilliantly illustrates a fundamental rule of this whole ecosystem. You don't really trade just one currency in isolation. Forex is always, always traded in pairs. Take the EUR-USD pair, for instance. This simply compares the euro with the US dollar. If you see that EUR-USD rate climbing, it means the euro has gotten stronger relative to the dollar. If it drops, the euro has weakened against the dollar. There's another heavy hitter right next to it, GBP-USD, pitting the British pound against the US dollar. So when you hear a pro trader talking about buying or selling, they aren't just buying a random dollar. They're making a highly calculated bet on which currency in that specific pair is going to overpower the other one. Now, on to what actually drives currency prices. Behind every single tick, every little bump on a currency chart, there are massive macroeconomic forces at play. We're talking about the heavy-hitting stuff here. Interest rates set by governments, national inflation levels, broad economic growth and employment data. Even sudden geopolitical events or shifting investor expectations can wildly alter a currency's value. Just think about central bank decisions for a second. If investors get a whiff that a country's central bank is about to hike up its interest rates, the demand for that currency can absolutely skyrocket. Why? Because higher interest rates make assets in that currency way more attractive to global investors looking for a solid return. So they rush in, buy up the currency, and the exchange rate shifts. It's an incredibly sophisticated environment driven by a fire hose of complex global data. Which brings us to leverage and market risks. Okay, the specific mechanic that makes Forex so alluring, and honestly so incredibly dangerous, is a little thing called leverage. Essentially, leverage lets you control a massive position in the market using only a tiny fraction of your own actual cash. On the surface, sounds amazing. You put in a little, you control a lot. But here is the giant, glaring trap that catches so many beginners. Leverage doesn't just multiply your profits if you happen to guess right. It literally multiplies your losses if the market turns against you. And in a market driven by unpredictable, rapidly shifting global news, well, that happens all the time. This is exactly why playing in this space carries such extreme risk. Plus, if you're an individual trader, messing around with leverage, you really need to understand exactly who you're swimming with. Forex isn't a kiddie pool. It's a massive institutional ocean. The main players here? Major international banks, colossal financial institutions, global corporations, governments, you name it. Big multinational companies use this market to handle routine cross-border payments. Central banks use it to stabilize their entire national economies. Institutional investors are shifting billions of dollars across borders in a single afternoon. So Forex is not just some casual little app-based game designed for you to make a quick buck on your phone. It's the actual plumbing of the global financial system, operating on a scale that's almost hard to wrap your head around. And naturally, because it's such a giant cash-rich market, it inevitably attracts bad actors. Look, just because the Forex market itself is a completely legitimate pillar of global finance doesn't mean every opportunity you see targeted at you online is legit. In fact, you have to be extremely careful. If you ever see someone promising guaranteed profits or pitching some zero-risk trading strategy, just walk away immediately. If someone claims you can turn $100 into 10 grand by Friday while lounging on a beach, recognize it for what it is. These are huge, glaring red flags. Those claims are fundamentally 100% incompatible with how this market actually works. Ultimately, the day-to-day reality of Forex is way less glamorous than the internet makes it look. It's a marketplace entirely defined by constant uncertainty. You can, and statistically, you very likely will, lose money, especially when you're just starting out. Like we've seen throughout this explainer, Forex is simply the global arena for trading currencies against one another. Yes, traders attempt to profit from those exchange rate shifts, but those prices are constantly being pushed and pulled by a web of economic and political factors that even Wall Street veterans struggle to predict. It's a genuinely fascinating machine to study, absolutely. But let's be crystal clear, it is not easy money. So understanding the basic mechanics, the currency pairs, those big macroeconomic drivers, the double-edged sword of leverage, that's really just step one of the journey. Because at the end of the day, the real question you need to ask yourself isn't, can I make money in Forex? The real foundational question you absolutely have to confront is, do I actually understand the risk before putting my hard-earned money into this? Because failing to fully respect that reality, well, that's exactly where the vast majority of beginners meet their end.